Markets are officially open for trade. Joining me now is Simeon Wallis, Chief Investment Officer at Aprio. Simeon, welcome to the show.
Morning, Ashley.
Good morning. What drove yesterday's gains after Friday's sell-off?
It was, we thought that retail stepped back in. Everyone had a chance to digest the news from Friday, disappointing payrolls, and really thought that this could be an opportunity where we might see the Fed move more aggressively as we move into the back half of the year than we were thinking coming into Friday.
So the market has been resilient this year amid tariff-related and economic uncertainty. Do you expect this resiliency to continue?
We do expect it to continue because as we move into the back half of the year, more of the pro-growth initiatives out of the Trump administration start to come into play. And we're starting to see that take effect already with an IPO market that was pretty healthy in July. M&A deals were announced, some significant ones last week. And as the capital markets start to flow, we would expect that the stock market would rally behind that.
Last week, the Fed kept rates unchanged as was expected. But following Friday's job report, what is the play here for long-term investors, Simeon?
Our perspective on the Fed is that we've ended the era of easy. And what we mean by that is we don't expect rates to be low like they were in that period post-global financial crisis, really through 2022. What that means is that the Fed is more likely to be gradual and methodical as it looks to lower interest rates. And we would expect them to pursue 1 to 2 cuts for the remainder of this year, and then perhaps looking beyond that, 1 per quarter. The key there being, do we get to see inflation, core PCE decline, or does that stagnate? If it does continue to decline over time, we would expect the Fed to follow.
Earnings season is in full swing. What trends are emerging across sectors, and what do you think that signals for equity markets?
We're in a world of bifurcation. One of the big bifurcations here is AI versus everything else. Anything in that AI value chain has performed extremely well, so not just technology, but we're seeing utilities and certain industrials perform well. Those outside of the AI value chain have struggled more, having to deal with tariffs as well as perhaps a slower growth environment outside of the AI ecosystem. So we're seeing this real difference in performance of companies based upon that.
And Simeon, you've said that tariffs are both a challenge and a catalyst. Can you talk more about that?
Sure. So they become a challenge because for industries where there's not a lot of pricing power, they have to figure out how to reform their own expense base to try and protect margins. Consumer staples are a good example there, but we also see it with things like appliances or anything that is getting imported into the US. At the same time, it really does present an opportunity as the Trump administration looks to accelerate manufacturing here in the United States and the derivatives of that. So that's infrastructure and utilities. All of that investment will come back into play as tariffs become a better guide for how to allocate capital by chief executives and companies. And we see that with the announcements with Japan and the EU and how the US came out far better than I think we were all expecting in those negotiations with over $1 trillion of committed capital to reinvest here in the US.
Where do you see the most opportunity for investors in our market today?
There are a few areas. We do believe that the dollar over time will continue to trend down off its high levels. Ultimately, that should be a beneficiary for international stocks, especially emerging markets. That's one area that we happen to like. Additionally, we're also attracted to areas that had a boom in the early stages of the pandemic and then subsequently have been busted, and we see those industries troughing out. Examples there would include some real estate as well as life sciences, where we haven't quite seen those companies start to perform at traditional levels, but we would expect them to over time as those industries start to rationalize. So those are really 2 key areas that we're looking at right now.
So AI continues to be a major growth driver. How are investors approaching this space with a long-term view?
They're looking at what those additional beneficiaries might be. For example, utility companies, the electricity that we need to generate moving forward to support data centers, that growth rate is expected to be significantly different than the history of utility companies have experienced over the last 2 decades. Given how long it takes to put that capital to work in the ground, we would expect that to be one of the areas, and the utility market has been one of the strongest performing sectors so far this year. Additionally, infrastructure related to build out electricity systems. So think about the industrials that are aligned with really helping to strengthen the grid would also be a long-term beneficiary of the build out of AI. So that's where we've been spending most of our time, or what are the second and third order effects for the growth of AI throughout the economy.
Thank you to Simeon Wallis, Chief Investment Officer at Aprio.